Hey guys, welcome back to the channel. Today we're going to talk about ETFs, index funds, mutual funds, and how they're different. If you're new to the channel, be sure to subscribe and let's jump right in. To start, the main objective that most people have with investing in index funds, mutual funds, or ETFs is to have an easy way to diversify. So you'll often hear the comparison that one of these index funds is like a basket, and in that basket are a bunch of tiny pieces of a bunch of different stocks. So with the S&P 500, for example, instead of having to go and buy a share of all of the stocks in that index, what you can do instead is to go and find an index fund that tracks the S&P 500, and you can buy shares of that. And by doing that, you're actually able to diversify, and it's almost as if you own a tiny little piece of all of the companies that are in that index. To get a full understanding of these different types of funds, we first have to understand what an index is, the similarities and differences between mutual funds and exchange-traded funds, also known as ETFs. We need to look at some use cases, so where you may want to buy one over the other. And then I'm going to show you one of my favorite ways to buy ETFs using M1 Finance, and I will show you why I like to do it that way. So to start off, an index very simply is just an average of how certain stocks are performing. A few names you may have heard of are the S&P 500, the Dow Jones, and the NASDAQ. If you want to see a more in-depth video on what a stock market index is, do go and watch the previous video where I go into depth explaining that. But I'll also explain it briefly here. You may have heard people talk about these indexes or indices, and you may have heard people say things like the Dow is down 100 points today or something similar to that. But what does that mean? Is that good? Is that bad? Let's break it down. So the S&P 500 is a group of about 500 of the largest publicly traded stocks, meaning stocks that people like you and me can go and buy. They take the averages of all of those companies using fancy calculations and they present it to us in an index. So basically it's just a report or a graph that's published that shows people like you and me how those stocks have performed on average over time. Indexes or indices are really just a comparison tool. You can't actually buy an index because all it is that report that is published. But what you can buy are index funds. Depending on the brokerage, these are also sometimes called mutual index funds, like you'll see that on Vanguard, and you can also buy regular mutual funds or ETFs. So to understand these, let's look at this lovely chart so that we know what we are looking at, and then I'll throw this on the screen again at the end once we have a better understanding of what this all actually means. So the object of an index fund or ETF is to match the investment returns of a stock market index or to track an index. All this means is that as the movement of an index goes up and down, the price of the funds tracking that index will also go up and down. And it's going to follow that movement as closely as possible. It won't always be exact, but it's going to be pretty close. So two examples of these funds are VFINX, which is the Vanguard S&P 500 Index Fund, and VOO or VOO, which is the S&P 500 ETF. If you look at these two funds compared to the S&P 500 over time, you'll see that the movement is pretty much the same. And why is this? It's because the stocks in those two index funds are the same stocks that are actually in the S&P 500 index. So for example, if Tesla is not included in the S&P 500 index, Tesla is also not going to be included in either of these S&P 500 index funds. If, however, it does get added into the S&P 500, it will also then be added into these two funds. Okay, so moving on to mutual funds. With a mutual fund, the goal is to beat the investment returns of a related benchmark index. All this means is that with an actively managed mutual fund, that means that the stocks in this fund are not going to be exactly the same as the stocks in an index. So for example, it would not be the same stocks that are in the S&P 500. With actively managed mutual funds, they usually have a fund manager, which is some Wall Street dude who's deciding what is actually in this fund and when he should buy or sell it. He wants to try to get his fund or that group of stocks that he picked to actually do better than the stocks in a stock market index. And I keep saying him, but it's usually a team of analysts in addition to the fund managers that are actually deciding what goes into these funds and when they should change those allocations. Now, the problem here is that fund managers are human, analysts are human, and humans make errors and they have outside influences on their decisions. So although it says that the goal of a mutual fund is to beat a given index, that doesn't necessarily mean that it will beat it. So what are some other differences between the two? Well, let's look at trading activity. So ETFs actively trade throughout the day just like a stock does. If you've ever used any day trading platform or you've just looked at an ETF in general, you'll see that it's charted the same way as a stock because it moves the exact same way as a stock and trades the exact same way as a stock. Mutual funds, on the other hand, trade once a day at the end of the trading day. So basically, instead of being able to buy and sell whenever you want, trades only happen on mutual funds once a day. When looking at these two types of funds, there's also a difference in who and where you can purchase them. So with mutual funds, they can be purchased directly from a fund, from a broker, or through a financial advisor. This means that there's usually going to be a higher minimum to even get started with a managed mutual fund or with a mutual index fund. If you look through Vanguard's available mutual funds and mutual index funds, a lot of the minimums will start out around the $3,000 range, meaning that you have to have $3,000 to even start investing in these funds. But with ETFs, there's no minimum, and since it trades like a stock, that means that you can buy it straight off of an exchange. It just doesn't have to be purchased directly from the fund or from the broker. And so what I mean by this is like with VU, which we used as an example earlier, that is the Vanguard S&P 500 ETF. But although it is Vanguard, you can actually buy that fund on something like M1 Finance, on something like Robinhood. You don't have to go through Vanguard to buy that ETF. Another big difference is the fees. With ETFs and index funds, the fees are going to be lower than managed mutual funds. And this is because there aren't managers managing it. So you don't have to pay for the fund manager, you don't have to pay for their team of analysts, and obviously that's going to make it cheaper. You can always look up the fees. That's not information that they hide from you. It's always available for you to look at. And in the next video, I'll actually go through the list of Vanguard's ETFs and index funds and show you how to look through those. So be sure to subscribe for that so that you don't miss that video. Now let's talk about when you might want to actually invest in each type of fund. And I'm pulling this info from a chart on Vanguard, so please keep in mind that I am in no way a financial advisor. We'll just be summarizing the information that Vanguard already has on their site and make it a little bit easier to understand. So looking at their chart, they say that if you want lower investment minimums, you may want to choose an ETF. If you want more hands-on control, meaning when you buy and sell and what order type you can actually use, you may want to go with an ETF. If you want an index fund, you may want to go with either an ETF or an index fund, which on Vanguard is also called an index mutual fund. And last, if you want to repeat transactions automatically, now this is interesting. On Vanguard, they say an ETF wouldn't be a suitable investment. You can't make automatic investments or withdrawals into or out of ETFs. Well, Vanguard, there actually is a way that you can set up automatic transactions for ETFs if you do it through M1 Finance. So I'm going to open up M1 Finance now and show you how you can actually do that. I do have a couple of other videos on M1 Finance, so if you're interested in learning more about the platform, do go and watch those. But in this, we'll mostly just be looking at how to actually set up those automatic transactions. M1 Finance is set up in a way that lets you buy fractional shares and build these pies out of different stocks or ETFs that you have chosen. So for example, we could build a pie that has VU and BND, which is just a bond ETF. So now whenever we fund our M1 Finance account and buy into this pie that we put together, it's going to purchase some VU and some BND. Now we can also set up money to automatically be deposited into our account and to automatically invest in that pie for us whenever we want. So to set this up, we're going to click on Bank Connection at the top of the screen, and then from there, we're going to click on Deposit. Now notice at the top, it says one-time transfer. We want to change this to withdraw from our bank account automatically. So we're going to click switch to a recurring schedule. From here, we can set how much money we want to be taken from our bank account and deposited into M1 Finance. And we can also choose how often and what day that actually happens. So once you actually choose what you want, you would click continue. And then the next thing that we need to do is to actually go back to the main page and enable this auto invest feature. This means that whenever there is a cash balance that is available in your account, it will automatically be invested for you. With both of these features set up together, that means that $100 will automatically be deposited into your account, and then it will be automatically invested into that pie that you built. For the minimums, M1 Finance has a $100 starting minimum for individual brokerage accounts and a $500 minimum for retirement accounts like Roth IRAs. You can deposit however much you want after that. So the next week or the next month, if you only wanted to put in like $20 more, that's totally fine. You don't have to buy in any incremented amount after you make that initial deposit. Something important to note though about M1 Finance is that they only have a trading window once a day, meaning that all of the orders that you place are only going to be executed once a day in the morning around the time that the market opens. And they give you that exact time window where it says next trade window on your main screen. So because of this, doing it through M1 Finance will take away that flexibility of being able to buy or sell an ETF any time of day. But if you're looking to get into ETFs with a lower starting amount and have it function a little bit more like a mutual fund, this is the way to go because it just gives you a more flexible and automated way to get started with ETFs. If you enjoyed this video, be sure to subscribe so that you don't miss the next video on Vanguard index funds, and I will see you guys next time.